Waking up, fire in the soul, shots on the screen, taking full control. London session calling, the volume is high. Watching the candles, reaching for the sky.
Strategy locked, no room for doubt. I know what the movement is all about. From the one-step plan to the two-step challenge. Finding that edge, keeping the balance, no distractions. Phone or silent mode, deciphering the market, cracking the code. Precision entry, the setup is clean. Living the life inside the machine.
Patterns forming, packets closed. Balance they slow down, standing strong through it all. Risk defined, profit inside. Seacrest Markets guiding every step into the light. Seacrest Markets leading the way. Making a move every single day. Charts in the vision, strategies align with every trade. Our future is defined. Charts in the vision, strategies align with every trade. Our future is defined.
Let's talk execution, let's talk speed. Damn, that crystal clarity is what we need. Some is action, just the price as I see it. If you dream of the top, then you gotta be it. Spreads are tight, the conditions are prime. Scaling up the ladder, one trade at a time. Global access, yeah, we worldwide. We're the brokerage back firm, right by your side. It's not a gamble, it's a calculated risk. Reviewing the data, checking the list. Green on the screen, yeah, the feeling is grand. The power of the market in the palm of your hand.
Master of the pulse, heart rate steady. When the window opens, I'm already ready. No revenge trading, no chasing the rat. Following the logic, the plan in my head. The market is a mirror, it shows who you are. Trading like a pro, reaching for a star. Seacrest is the vessel, the compass is true. Breaking every barrier, breaking on through. Discipline and patience, the tools of the trade. This is how a lasting legacy is made.
Chasing the sun from the east to the west. Put the strategy through the ultimate test. Sydney is waking while New York is sleeping. Watching the levels, the promise is keeping. Laptop open by the ocean shore. Every pip gained is an open door. No 9 to 5, no shackles, no change. Just the cold hard facts and the capital gains. From the rooftop bars to the quiet floor. Seacrest Markets gives you so much more.
Patterns forming, markets call. Balance based drawdown, standing strong through it all. Seacrest Markets leading the way. Making the move every single day. Charts in the vision, strategies align with every trade. Our future is defined. Charts in the vision, strategies align with every trade. Our future is defined.
Then the lights let the candles glow. Watching the Fibonacci start to show. Resistance turning into support. This is the craft, this is the sport. Back tasting nights in the early mornings. Leading the trends and the volume warnings. It's a chess game played on a digital board. Striking the keys, striking the chord. Elite mentality, top tier tech. Seacrest provides the ultimate check. MT5 or match trader speed. Technology serving the traders' need. Daily limit set, max allocation. Building up capital, pure dedication. It's more than the payout, it's more than the gain. It's the freedom we build, breaking the chain.
From the first deposit to the maxed out account, watching the influence and impact mount. We're the new era, the elite of the screen. Navigating depths where the giants are seen. Seacrest the name, the gold standard inside. Turning every vision into brilliant light.
It's a mindset,
Keep grinding,
it's a lifestyle.
keep crushing. We own the vision. We are the flow.
Good morning and welcome everybody. Seacrest Markets, happy Monday. Apologies for the later start this morning. Due to some personal circumstances, I had to delay the start by just over 1 hour. Back in the office, actually check the markets this morning. Overall rundown last week of January 2026. So overall, big week ahead. I do think that markets will be fairly quiet coming into Wednesday. Now, why Wednesday? For those of you that are listening, whether that be to the recording or whether that be live, we have the Fed week. So Federal Reserve on Wednesday, we're expecting the Fed to hold rates at 3.5 to 3.75%. So what I realistically think is it's all about the tone. So we'll be listening to how Powell's tone will drift towards hawkish, with sticky inflation, with obviously the 2.8% PCE inflation, which could mean that we continue to see the equity rally stall. Now, if you look at the chart on your screen, you can see that on Friday we had that huge bearish day. Now, a few days prior, we were talking about how we were expecting the gap to get filled. What happened? Gap got filled. We're now rejecting from the gap. Expectation on prices, if supply is now going to stay in control on indices, then the theme or the view from here will be looking to take this low, which that's down at 67.81. So give or take 150, 200 points down to the downside, which is not too crazy. Good opportunities to continue getting long when we start to dip down into these areas. However, I think the market will Monday, I think we'll be okay. I think we'll have some good volume in the markets. I think stepping into Tuesday, Wednesday, no one will realistically want to build their positions. So we'll see some holding, low volumes, maybe a bit of volatility, but fairly average. But yeah, realistically, it's kind of how I look at all my weeks. When I look at big data impacts or big macro, I always think, right, how can I position myself intraday around this news? What news do I need to factor in? Because like I said, we have the Fed Reserve this week. We've got GDP and growth flash Q4 from the Eurozone as well as Germany. And this week alone, with personal circumstances, I might not necessarily be able to be fully prepared for the markets before the open. So I have to be quite comfortable with missing any moves during Europe. Now, I know I don't relatively trade Europe just because I'm primarily focusing on what I do on my day work. The US, I do prefer to trade it anyway, just because of volume. We've got the crossover between European, UK, London session and US session as well. So it is a better session from a volume perspective. And the fact is, on a CFD basis, we get to trade whatever instrument we wish to, whether we want to trade the US 500 now, whether we want to trade it later, we can. And of course, we can hold it overnight. So we're not too discouraged by building a position. But with this week, the Fed coming out obviously on Wednesday in the US, it puts us in a position of capital protection. And that is first and foremost from a trader's perspective. Being in a position is good, but you have to understand what risk you're exposing yourself to. So I won't talk about too much more about the Fed or the GDP growth there. We spoke about the big macro data for this week. Of course, the FOMC is going to be the main event. So that is where the majority of you will be focusing your attention. As for last week, I already touched upon it. We've now entered the last week in January. Hi, Luffy. Good morning. We're now at a historic crossroads. The way I'm seeing this market, it isn't really like many markets that many of the newer individuals would have experienced or seen before. The fact that we're seeing gold rally a significant amount in January alone, we've had a record-breaking ascent in gold and in silver. We've had a pretty dramatic de-escalation rally in equities, and with it being the last week, as well as the shift into the FOMC, and the fact that we're now moving into tech earnings, specifically focused on the US indices here, it's going to put a little bit of an interesting twist on the end of the week and the end of the first month of the year. I know that, over the weekend and over, factoring in the weekend before, we had US tariffs on European economies or European countries. Then we followed with that midweek breakthrough from Davos, where President Trump suspended the tariffs in exchange for the Arctic security framework, which then, as we saw, triggered the massive rally in global equities as well as the euro. So those of you that trade FX would have been long the euro on that particular moment. But once we got that gap fill and we really failed to take out that supply or that area of resistance, we've traded away from it. So very touchy up here. Of course, touching on gold very quickly, it posted its largest weekly range in history. It surged over 8% to hit a near peak of $4,985 an ounce. It closed the week just $20 shy of that 5,000 level, which is also a psychological barrier. Silver, it shattered $100 an ounce for a brief moment there, which again, historical move, first time ever. And it ended the week near around $102.60, which is quite parabolic for a hard asset. So we're seeing quite a big frenzy in hard assets at the moment. Again, that's why it's quite a rare scenario. We did see risk rally. We did see hard assets rally. And now what we're seeing is pretty much a tale of two halves. So the transition across into the DAX, for example, and I'll bring that up quickly. Give me a second. My hands are still cold because I took my daughters to school this morning. Why has it done that? I took my daughters to school and it's freezing and I haven't warmed up. So the DAX recovered the 25,000 level. Obviously, we can see that we're trading just underneath that by about 200 points, but 117 points roughly. But that 25,000 level is key now. So that's, again, a psychological level. We traded up about 25,500 during midweek, traded back down below. Again, similar scenario on this. When we look at where the markets were last week, we had that gap down. We're yet to fill it. We're bearish on the leg and we'll be bearish on the lower time frames, but we are overall still bullish. If we look at where we are on the daily, we're holding that psychological level around 2480, which is that previous high. We're respecting support as well as the demand area that's trading inside here. But we haven't done anything significant since coming into that level on Wednesday. So we, of course, came into 25,000 here. We've then traded below. What I'd like to see, if we are going to continue with the bullish theme, I'll just use this as one leg. I now obviously want to see us tackle the barrier of 25.5s. If we can do that, then again, similar scenario, we'll be looking at targeting 26,000. We'll look for a pullback. But this is somewhat different. If we start to see markets rolling over now, we fail, we come back in to fill this gap, we could then look to actually take out this low, and then we start a bear market, which can happen. We're very much overdue a sustained period of deflationary territory, of sustained lower macro policy data. But when we saw this in 25, which was that huge move, that was 8%, right? And that's a big move. So if we just take that high and look for 8%, sorry, my cursor's not. So if we take between 7 and 8%, that could be pushing us down to 23,000. So somewhere in that 23,000 handle could be the range. There's a lot of demand on the left that could be used as internal liquidity to trade lower. And maybe coming into taking out somewhere here and basing. But yeah, That is the extreme of the move. So we're in a particular position now, transitioning into the other half of the two-side story. The S&P 6,913. We can look at that again in a moment. The Dow 49,384 was roughly the level we were looking at with the back end of last week, which was from my notes overnight. So overall minor losses, despite that rally that we saw, and of course a 17% plunge in Intel, which is the ticker INTC. So of course I'm long INTC. I was long quite a significant amount from early parts of 2025, heading back into Q4 2024. I saw it very much as a fallen angel, as a very much a value play, so a value investment, and it has been a good move. But obviously it's very much exposed to what was going on last week. Now, in terms of the risk on lag, kind of transition across into Bitcoin, struggled to maintain and continue with momentum. It closed the week at 89,500. Overall, crypto underperformed significantly compared to gold and equities. Institutional capital, by the looks of the volumes, typically favored tech and AI-linked equities, as well as traditional safe havens, such as, of course, we've seen gold and silver. So it's going to be an interesting week. The Fed are obviously looking at what we are. You know, everyone's going to be looking at where the Fed are trying to position. Is it going to be a hawkish tone from Powell or not? And if he does actually remain rates at 3.75%. So I think we need to keep an eye on that. Does anyone have any positions in the DAX at the moment, or in the S&P or gold? These are pretty much the last trades that we took. We definitely could have gotten something here, but I didn't do that. And then look, like the market. So market gap down. So if you were short into the weekend, then of course you had to factor in your weekend gap risk, whether that be some positive tones over the weekend or some continuation to the downside. But overall, we're just continuing short off of that 6.9 level, that 7,000 rejection really, which was the target. We will get 7,000, just a matter of timing, I think. But markets obviously gapped down yesterday. We opened up nearly 0.5% lower. And then what did we do? We rallied. So there was no volume. And then volume really started to kick in here. And then again, had big volume there. So we've recovered that gap from overnight anyway. Wonder what there was on the higher time frame that could show us why. Again, it's just some point of demand, really. Some area of support that kicked in. We've got this area of supply that caused the break of the high, which then we had that flip, which again is why we broke. We've come back in. Let me just zoom in to get the wick on this, because I know I'm not on the full candle. There we go. So we had the wick, which was the rejection of this level. We traded back up. We then flipped. We've rounded because we're trading inside that range on the higher time frame. And then obviously we've come into 68.60, 68.70s and rallied. So we're still trading. We're still trading inside that supply demand range. There's nothing really too drastic in terms of the moves. I mean, that's quite a nice opening long. I don't know if any of you traded Asia session and caught that. Let me come down. I wouldn't recommend trading on the 1 minute or the 2 minute if you're not seasoned, experienced veteran with discipline, with intuition, with market experience, because of the weighting behind it. It does hold a lot more aggression. But there's after we started to take out supply, we wanted to see demand take control. You have got this demand range here that did get respected. So you could say it did after the failure to break, but it's not the cleanest. Again, coming up here, we trade up. It comes back in to trade into the range, pushes up. We then round off and we fade into this level. So this is realistically where, what's the time here? 10 p.m. Sorry, my phone's ringing, it's distracting me. Comes into this level, 68.90s. We reject, which is that realistically the first point of demand that actually respected. Supply then develops. We fail. Like, this is, again, rangy PA. You wouldn't expect massive amounts of volume during the rollover into the new session, heading into early Asia. Asia comes in, very good volume, very tight volume, not much kind of moves, the directional, but obviously it's very clean in terms of its directional move. You take out this high. This is, markets are boring, really. Analysis is boring. So don't get too excited. All the people that hype it up, they just do it for pure entertainment reasons. We've got that demand range. We trade up, we break in, we fail to break. Nothing done, no moves, not interested at all. We break. Okay, we break, we come back in, we trade higher. Boom. Boom. So it's very tight, and this is where you could try to get in long, but what are you aiming for? Like, you aiming for this? Well, we're not there yet. Is there something in the leg on the left that we're maybe looking for? We could target something inside here. Is there any resting volume? Have we got this extreme that we can maybe target? There's nothing. It's very clean. You're just trying to edge up this market, maybe get a few R out of this trade. Sorry, I saw something load on my right hand side. So overall, very tight markets, very tight volumes, just trading up, very clean, very, this for the lesser experienced people is very efficient. This is a very, very efficient market. Wow, Mr. Underwood, good morning. Welcome to Seacrest Markets, you legend. How are you, Anthony? Good to see you. So, where's trading out of Asia? Very, very tight. Very tight at all. What's coming into London? Let me move it to London session because it's 4:30 and people are going to think that the markets aren't trading. So coming back into +5 from New York, as we traded into London, the volume started to kick in. Also, European Open kicked in. We've traded into what? And this is where it gets really tricky, because if you're looking at areas of resistance versus the supply side, you've got this area of supply which rejected that exponential extreme at the supply side. That obviously took out this internal support here, which is also factoring in internal demand. No major reaction, huge Marabusha engulfing candle, traded down. But again, why did support or demand hold if supply was in control? Well, later on, as we saw, supply rejected. We then had that huge opening gap down during, obviously, Asia, coming into Asia session. The gap fill got completed, which is right here, which let me just draw that on. I'll change that as well as a color because, wait, why is it? There we go. So we filled the gap. We then consistently traded in a very tight volume range all the way up. We've now rejected. So in theory, if we are going to be continuing with this bearish tonality or bearish theme with a risk-off style, then risk-on style, what's good one always? Biggest challenge when you were starting out. Wow. I can answer that shortly, Vinny. So, this is the 15 minutes. So, again, if you're looking for an intraday and you're experienced with intuition, you are going to be wanting to come down into M5 or M2 or M1. But if you're looking at some form of swing, then you're probably in already. If you're looking to play the weakness from this, ATR 100, maybe placing your stop above, you'll be looking at targeting down at 68.51s, which is also that extreme support, extreme demand range. There's 3R available there. If you're looking at an intraday position, then maybe you come down into the M2. Again, no trade potentially yet. But this is all educational information. This isn't an execution, soft trade idea. This isn't a signal service at all. This is purely for education and analysis. So, my neck's hurting. 1 sec. I need to move my keyboard because I'm looking at this screen and my camera's on that screen and my chair faces that way. And I'm not getting a stiff neck. But you can look at the side of my face. So we've taken out that high, but we failed to obviously continue or respect the break / retest continuation. So what have we done? We failed. We then need to look at what was the last point of support or demand that took out this high, which was this area, okay? So what's then happened? We've respected, we've traded up, we've failed to break highs, we've then traded lower, which thus has then respected the supply that is in control. Now what do we have? So I don't like to trade tops, as you all know, and as if you've been around and listened to the live sessions a lot of the time, I like to wait for the move to develop, so I tend to miss out on the first quarter of any move. Again, it's respective to the leg that you're trading. So now what are we looking for is we'll be looking for some area of resistance, be it the extreme or within the leg, for price to come back in. Realistically, I always look at the extreme. I don't mind missing out on that first part of the quarter, and I can actually then continue to the downside. I'll be then looking to get short, but I won't just be looking to get short from a rejection of some form of supply. Again, we always look at confluences. Depends how you trade. Are you looking at MACD? Are you looking at RSI? Are you looking at moving averages? Are you looking at exponential moving averages? Are you looking at pure price action? Are you looking at some formation? Are you looking at divergences? Are you looking at harmonics? Are you looking at bearish flags? Are you looking at pennants? Are you looking at Ishimoku cloud? Are you looking at Bollinger Bands? Maybe looking at VWAP? Maybe looking at anchored VWAPs? Maybe just looking at, I don't know, some form of imbalance that you're targeting. So we want to see that supply is in control. We want to see that the bearish leg has been confirmed. Now, this is very tight PA. We are starting to see the move go, but it doesn't mean we need to be impatient. If you're a new trader, we don't need to chase that first move to the downside. We're quite comfortable with missing this move. But if we don't miss this move, we'll see for a pullback. We'll look for some form of respect on the supply side. We can then maybe even go down to a lower time frame, like a 1 minute, and then look for something to get short. But you have to factor in what's to the left, what's on this front leg. The S&P has resistance at 7,000. There's support at 6,840. So we do need to be cautious on any trade we're taking. Euro dollar from a risk perspective is very consolidative. It's there's support at 116.80, which we'll take a look at in a moment. We want to see a move up to 119 on a dovish Fed. But we can't trade what we think. We have to trade what we see. And at the moment, we're seeing retracements in risk. Yeah, appreciate it, Anthony. Thank you for joining. This is a fairly new structure and foundation for Seacrest. We're running educational and analytical lives every day. Traditionally, it's Monday, 8 a.m. to 9 a.m. UK GMT. I've shifted it back to 9 a.m. to 10 a.m. UK GMT just for this week. Maybe into next week, just due for personal reasons and errands and endeavors that I need to do, unfortunately, which means I won't necessarily be trading European session, which is what it is, right? What did I struggle with? So unofficially, and I say unofficially because I was obviously young. So professionally, I entered the markets at 17 in a junior position, a junior capacity. But when I was younger than 17 and studying economics and actually learning to trade and trading, for the first 2.5, 3 years, it was about understanding the markets, reading what's going on, identifying higher time frame, looking at structure, and that was it really. I remember the first few weeks looking at how macro data, because I was studying economics in school, for the first few weeks it was understanding fundamentals and structure, and there was always key events that, again, I know all now, but when I was looking at those key events when I first started in the markets, it was really trying to figure out the what, the why, and the how the market reacts to them. And because I was quite lucky to have family and family friends that were in the market, some questions I would go and ask them. I'd say, oh, let's just randomly pick an example. The NFP, you know, why does the NFP have such a big stronghold over the market? Why is the barometer 200,000 plus minus? What does that actually mean? You know, and then the questions of complexity come around it. So, you know, for example, X, why do they do why is there a revision on the previous month? And I was very keen on looking at the data. Sometimes I was too over analytical, which caused hesitational bias to get involved. But when you really kind of understand the way the market is and you start separating out the knowledge versus the execution side and focus on somewhat of a systematically discretionary approach. So when you first start, you look at mechanical, right? It's market does this, you do that. But that will also have a fixed percentile on probabilities. And you only start to get what you call intuition once you get experienced. And once you gain that experience, then you start to develop intuition. You start looking at the way the market is. You go, right, based on intuition, X, Y, and Z. So the first couple of years, my biggest challenge, like probably most people, was identifying and timing the market. But I mean, when to trade if you're doing intraday. When it came to investing, I never really had a problem. You know, I never really worried about timing the market. And I know it's a cliche thing because I was building a portfolio of equities or stocks. And that was just about understanding realistically, does the company look good? So from a balance sheet perspective, on a micro scale, what is the overall theme in the market and how do I get in? I wasn't really interested in the price as such because my thought was, well, I'm buying it here because I believe it's going to go higher on a portfolio perspective. But on an intraday perspective, it was really trying to understand when to get into the market, when not to. And I think I was about 6 weeks in at the time. I don't forget the event. I forget the time frame. I was about 6 weeks in, maybe a bit longer. And it was an NFP Friday. And I came across this person. And I was dead against it. And I never traded it. But I came across someone somewhere. And I watched them straddle the NFP. So for those of you that are new to the markets, look at this move. Absolutely berserk. Huge move to the downside. So I watched someone straddle the I don't know what, they must have straddled an FX cross. They must have started maybe a US dollar major, not a cross. And they straddled NFP. And they got long and they got short. That's what a straddle means, right? So you're basically getting a position either side of the market. And the NFP data come out. And like everything, you probably have seen this, you'll get that huge expansive move in one direction, right? It was, you know, let's say it went long. And they got in. But when they got in, the candle then dropped. So they're in this long. Now they're in the short. And they're fucked. It then whipped them. It wiped their whole balance out. And they ran. I don't know what they were doing. I can't remember. But I just thought that is such a key lesson. And they're always selling services, right? They're always selling, follow my signals. We trade this. We make this. We do that. And I was lucky enough that because I was so over analytical, it held me back a little bit. And I never traded that event. But you would have blown 20, 30, 40% of your account balance on that trade, maybe even more. And you'd be kicking yourself because when you're that young, you know, you're borrowing money $50, 50 quid is a lot of money. You know, when I wasn't working at this point, I was still in school. I had a paper round and I sold sweets and drinks, but I was never earning, you know, significant capital. You know, if you're clearing a couple of £100 a month, that's a lot of money. If you're putting that into a trading account that's not in your name, for example, or you're trading on demo and you're watching your demo fees go, you're clearly not a good trader because you're learning the markets. And that's a key thing to take away. So the main challenges for me initially were identifying when to trade, when not to trade. Again, I was surrounded by some incredible people. I went to lunch with some absolutely exceptional people that worked at Barcap, that worked at small private funds as well. I remember sitting with one guy, and I won't mention his name because he is on Twitter. Again, not Twitter how we know it. And his story is genuinely amazing. So he's not from a financial background. He was a mechanic, so a car mechanic, an auto mechanic. And one of his neighbors growing up was an investment banker. I don't know what investment bank he was at. I do think he was at one of the big boys, but I can't remember the actual bank itself. And it was as beautiful as this story is hopefully going to be relayed to you. He walked along the road to his neighbor and he said, listen, I want to get into the markets. Currently, I'm a mechanic. And bear in mind, he was a lot more grown up at this point. So he had moved on, but it was his family neighbor. So, of course, he used to go around and see his parents. And he walked along the road to his neighbor. And bearing in mind his neighbors had amazing cars, all the Bentleys, everything else, etc., etc. And the guy said, I want to learn how to trade. I want to be in the markets. And the guy said, well, funny enough, I'm looking for a junior. And this guy's really quite old at this point. You know, he's in his mid-30s. Junior positions are available, but they're very difficult to get into if you've got, you know, experience or you're older. They want someone young that can learn very quickly. So he had that on his side. And this move is insane. We should have probably just jumped on that momentum because we had that rejection here. Anyway, and the guy said, listen, I'm looking for a junior, come and work for me. And anyway, they ran this fund. He just left the industry, got lots of money. He wanted to build his own fund. And it was a family fund. So he had his sisters working for him. Obviously, my friend worked for him. And they ventured through a couple of different strategies. They used to just trade macro releases. They used to just absolutely fill their boots in size on macro releases. Then they started moving to more systematical, and they're doing really well for themselves. And this is, I would say, core 15, 16, 17. I was probably by that time, I was about 6 years in. I'd say I was in the city by that point. I was about 20, 21. And so coming back to the moral of the story, without going too much on a tangent, is the challenges that I faced will be different to many of what you faced, because where I was surrounded by other people in the markets from a very young age, like I said, had family in the markets, had family friends in the markets that were at some of the big investment banks. It was different for me. You know, I took a liking to collecting and investing in things early on, whether that be die-cast kayaks that I collected in boxes, stamps, so philately, Warhammers, which again, great stock to be in if you're long. And then it went on from there, really, buying a stock here, buying a stock there. Again, I don't necessarily like that book and I don't like this guy, but when I was about 12 or 13, I'd already read pretty much the whole series. I'm pretty sure it was about then, of Robert Kiyosaki's Rich Dad, Poor Dad. And again, when I was that young, my mind was a bit like a sponge still. So I didn't necessarily know. I was quite naive, I'd say. I didn't really necessarily know right from wrong from Robert Kiyosaki's perspective, but great book to read. My brother, again, I have an elder sibling, so I had 2 older brothers, and my eldest brother was reading that book, a lot older than myself. He gave me that book, and we shared the books, we shared comments on the books, we discussed the books. But again, my favorite games growing up were Monopoly, chess, the Rat Race, and then of course a couple of strategy games. But I wasn't a massive gamer. So the challenges that I faced are probably different, but similar scenarios: psychology, risk management. That one there, risk management. Once you've got your edge, once you're confident, so they say psychology makes up about 70 to 80% of the complete framework of a trader. And that's only because you need to really understand how to manage your emotions and behavioral finance during every facet of trading. But once you've got your edge, once you're confident that edge works based on forward testing, proven data, etc., 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 whether you statistically modeled that data, that you understand the mathematical edges, your confidence grows. Thus, that move is insane. Your confidence grows, so your edge, it becomes more about how to manage that edge, how to stay in the game. And something that sticks with me all the time, and I repeat this like a broken record, is it's all about capital protection and staying in the game. The longer you stay in the game, the more experience you become, the more intuition you gain. Hopefully, the more people you meet, even more experience is attained, thus more money potentially will be made. So the longer you stay in the game, the better you are, the better you will be. I think social media has a blessing and a curse, double-edged sword. It's a great thing for growing your businesses. You need it, right? You need it. You need YouTube. You need social media. But focusing on the entertainment value of products is the stupidest thing ever. Really is. There are far too many people out there selling entertainment, and they grow. They sell you entertainment and drivel. And respect to them for catching the audience. There are people out there that have got 250,000, 500,000, 1 million followers and subscribers and something like that. And they're just wild. They're entertaining more so than they are the opposite. But people value clearly entertainment more than education and experience, which is an interesting juxtaposition to be in. So just bear that in mind on your journey, because you will get sucked into the wrong things. And if your gut tells you that it's too good to be true, it will be. I've seen it in any industry, and I've seen it a lot of the times, and I still experience it to this day. But just take your time. So hopefully that answers it in a very convoluted way. The key areas that you will challenge as a trader and be challenged with is you'll size up too soon, you'll lose a lot of money, your psychological elements will be hit, so your mental attribution will struggle. Then you'll focus on risk management because you're too scared of losing more money, because your life depends on you being a successful trader based on your own opinion, but it doesn't. You'll get to a stage where you want to quit your job to focus on trading too soon, if not have already. And I've never really recommended that. People always say, I want to be a full-time trader, blah, 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 blah. It's very niche to be a full-time trader. Most traders out there, other than props, for example, that get, other than props that are like at a firm, most of them get a base salary. They get a base salary. They then get paid on their performance, and that's usually on a quarterly, semi-annual or annual basis. Not 30 days like funding firms or 15 days like funding firms. But the difference is they're employed to make money for that firm, and they get paid on their performance, and that performance is reviewed as per one of the metrics I mentioned above. There's not many firms where you are, other than the new world, there's not that many firms where you are a self-employed day trader. There are, and there were many firms back in early 2000s, tower trading, oil, Obviously, you've got your SMBs. You've got a few techs. You've got lots of old, not many of them around anymore. Obviously, there's a few that I mentioned that are. But they're self-employed. And people always go, well, let me trade more. Let me become a full-time employee. But the best thing to do is have a job, have a career, and trade and invest. Do all three. There is no reason you can't. If you work nights as well, you can trade. You know, you can trade the European session. You can actually sleep and then wake up, trade the US session. You can really make it work. You don't have to be sitting at your screens all the time. Anyway, so this move obviously is accelerated since European Open. You know, we're trading into this internal area of demand at 6,900s. It's a pretty big move on the Open. Let's see what gold's doing, because that will have traded up. Okay, so wow. So look again. We've got that huge gap up. You know, we did try to fill it. You can see that price on that opening gaps tried to fill there. We've obviously then traded higher through Asia. These are unlike times I've ever seen before. $5,000 a troy ounce, and we're just ranging. So we're now above 5,000, right? We've got point of control sitting at 5,003/4, so 5,076. Again, higher lows are being printed just to give you a visual on the chart here. We are starting to trade, not in an equidistant channel whatsoever. An equidistant basically just means two train tracks running alongside each other at an equal width continuously. We're making higher highs, higher lows. Again, we've had a breakout. So the point being is now we'd expect some form of consolidation, profit taking, transitions of individuals selling out of their long positions, shorts being taken out of the market, because people would have been trying to short that 5,000 handle. And anyone that held shorts going into the weekend would have been gapped out, and they would have been slipped significantly with most brokers. Luckily, most brokers will have negative balance protection in place, so you won't owe the broker any margin, you won't owe the broker any money. And of course, if you've got stop out levels initiated by your brokers, they'll do their best to close you out of that position as best as they possibly can. Again, so coming into this week, I was looking at 5,000 being the target. If we continue to get this uncertainty, sorry, I'm so sore. If we continue to get these uncertainties going into the week, then we will see markets and gold specifically trade higher. We know we could see 5150s by end of week. If we start to see some really significant bullish tones, then we could actually start to see a transition out, especially when we've got Apple and Tesla earnings as well coming out. So Mag 7 earnings this week. Does anyone have any questions at all? Any queries? Great question, by the way, Vinny. I hope it answered for you, mate. But I'll be looking to see where the markets go this week. Greed and discipline. Second. Where are we on the old Bitcoin? If Anthony's still here, Anthony, are you still swinging? And I don't mean like that, I mean trading. See, all this has done is come in to fill that. So essentially, we filled this range where the imbalance is. And we've rejected it. Good. And this is, I think this is what we discussed upon. I know we did actually. I don't know why I said I think. We discussed this last week. So we discussed the tight ranges in price and then the scenarios of we could break up, continue higher. We could break up, trade back in, fake, and continue lower. And that's what we've got, right? There's 6+ scenarios what could have happened. And we've got probably one of the worst ones, which is markets broke to the upside. Buyers will have got in on this break. Buyers would have got in on this retest. And then sellers have kicked in. Buyers have been squeezed. Stops probably would have been below here or below here. Stops have been taken out. Stops have been taken out. What's then happened? Sellers obviously have got in. Buyers have tried to squeeze. Maybe their stop, because your stop could have been here on the long as well. So your stop could have been here. You would have got squeezed out, wicked. Then what does market do? Market loves a trier. Market then fades out. We trade below, so we broke out. So what we'd want to see is supply take control, and then we'd want to be seeing a further breakdown to the downside. So a lower high printed, and then we'll see the move from there. Wow, it's so cold. Something to factor in as well, which we're getting at the moment, is the rejection from this extreme of this range. So I'd like to really see this level break, if I'm honest. If we're going to look for shorts, I'd like to see something like this. Because whilst this level's holding, there is still that opportunity that we do this. We use this as liquidity. We come back in, we respect demand, we then start trading higher. And that would have got your longs taken out. That would have got your shorts taken out. And now market can move higher with very little friction. So market's doing exactly what we talk about all of the time, squeezing the sellers, squeezing the buyers. And right now we are waiting for confirmation that we do want to go short. And I think we could probably see that on the lower time frame, if I'm honest, but let's have a look. So come back in. This is the range. We've taken the high. We've traded back down through Asia. Oh, sorry, through the weekend, through Asia, we've traded lower. Very, very tight range, little volume, very efficient markets. So very efficient, very efficient all the way down. Traded lower. We've come back in, respected, and this is on the M15, so it'll get even more detailed as we go down into the 1 minute, the 2 minute, 5 minute. Traded lower, so demand is in control. We've got a lot of demand to the left. We've got this area here, which is at around 87.1s. We have this level at 86.6s. Again, not much really. Very efficient. We need to see a blowout really, and then we can work over. This is the blowout here. So look, this is the low. We have price pushed down. We have the supply respected. That's the blowout. Why is that the blowout as well? Because it comes into nearly European Open, UK Open. Frankfurt's obviously at 7, so we've come in here. We've got European Open, UK Open done, and then we could have got in there. So that's the blowout, but it hasn't really committed to the downside, has it? So we could have got in. Could have got in here. Again, your minimum is a 1-to-1. Has to be. You can't really trade on a negative RR, so you're nowhere near in the P&L at the moment. Point of controls here, so I would always be very, very careful about being in a short. And then you need to look at the overall leg and say, okay, where could I target? This is the leg that you'd have to focus on, which we're in the discount of the leg. So taking a short in the discount is lower probability. So you have to be careful. If obviously you're going to be looking at where the 4 hour is, then again, similar scenario. We're actually on a bullish retrace coming into the retest of the existing support level. Sorry, not supply. I'm trying to say resistance for you, or demand, but extreme support, which is now going to turn resistance because we've got that level there, and we're rejecting off that level. So no, my phone just doesn't stop going off. Emails. So yeah, just be careful. Just be careful. We could target something lower, but just be careful. Oh, excuse me. Does anyone else have any questions? All right, so quick recap. Tomorrow we've got US consumer confidence, as well as Microsoft and Meta earnings. Wednesday, Fed rate decision, FOMC, as well as Apple and Tesla earnings. On Thursday, we have US productivity and personal spending data. And on Friday, we have Eurozone GDP and US PPI. So gold, we're going to be looking obviously for continuation to the upside. Bitcoin, we're currently neutral, looking for potential pullbacks or some form of blowout, significant blowout. Euro dollar consolidating, and we are cautious on the S&P. So just keep an eye out for what's going on. Earnings will obviously, if you trade indices, earnings are obviously going to be a big factor into understanding what the Mag 7s are doing. The index will follow based on the weighting. And if you're long gold, just don't get too greedy, as per Ryan's comment here. Be disciplined. Follow your plan. Don't chase the markets. Manage risk. I don't have much more to say, so I'll just go across the way markets are and see what's actually going on since the open. FTSE's down, spot 0. Italian MIB, spot 08. All right, so in terms of markets, in terms of Seacrest Markets, I keep saying markets, but Seacrest Markets. In terms of Seacrest Markets, please, if you are enjoying what we do, whatever channel you're on, YouTube, please like, subscribe, turn notifications on. Instagram, please follow, retweet, repost, and of course, turn your bell icon on. And if you're following on Facebook, do the same. We appreciate your support. We appreciate your comments and questions and your feedback. And as always, trade smart, trade safe, and trade Seacrest. Have a good week. See you this time tomorrow, 9 a.m. UK GMT to 10 a.m. UK GMT for this week only. If it changes, I'll let you know. But again, trade safe, trade smart, trade Seacrest. Have a good week.
Patterns emerging, psychology's key. Discipline strong, no greed in the spree. Risk managed tight, emotions in check. Seacrest